Good afternoon. This is Craig Modelmog for this week's episode of Wall Street X's and O's. Today is January 15th of 2021. It's crazy. We're already halfway through the first month of the year. It is nuts. But anyway, before I kick things off, I do need to lay down my disclosure, which all of the opinions and thoughts on this show are basically mine. Although all the information is 100% factual. Investments can and will lose money. They are not FDIC insured. And without further ado, and this is also not a solicitation to buy and or sell anything. This is really educational focused, trying to help you become a better investor or gain a better understanding of what's going on. For those of you joining me for the first time, as many of you know, this is an uncut and unedited version where we just kind of let it rip. And our hope is that we're talking about the things that are important that go unnoticed or unmentioned over throughout the week. And there are things that I really feel are very important that help us understand in context what's going on from an economic standpoint, both globally and domestically, as well as from a governmental standpoint, as well as some of the specific main data points that I track and map and measure on a daily basis. So if you're here for the first time, welcome. For those of you that are back, I thank you. We really do appreciate you joining us. But without further ado, we're going to kick things off. You know it. I got to hit on unemployment because I do, although today is going to be brief. I'm going to really hit on interest rates and talk about the Goldilocks analogy. Yes. A little bringing in some stories today. I'm going to touch briefly on the Biden stimulus package, although I'm not going to spend a lot of time there. And then we're going to kind of have a COVID update. I was on a really good call today, kind of providing a COVID update and just got some interesting data points. As you know, I'm really big on the data. So to kick things off, unemployment, we saw it rise this week, which, you know, for those of you who were on the show last week, you know, that's what I was predicting or what I was anticipating. Just as COVID cases are rising, we're seeing certain parts of the country start to shut down again. And basically we saw that to where our weekly numbers were up by 181,000 and our total continuing jobless claims were up 199,000. Now, again, we do have Trump's deal or the deal that Congress or the House and the Senate did put in place, which was the $900 billion deal, which was the $600 checks to individuals who qualified, kids 18 years of age and under, and they also extended unemployment benefits to that $300 a week. So that I think is in place, but I think we could see a couple weeks worth of unemployment remaining and staying high. Obviously, time will tell, but that's kind of what I'm anticipating. All right. But I do think as time goes, due to COVID vaccine and then moving into the time of the year, I think we're going to see things start to improve, and they could start to improve at a pretty rapid rate. Let's move on to interest rates here. Interest rates, I'm going to focus on the 10-year Treasury, which that tends to drive a lot of the interest rate sensitive areas of the market, whether it be mortgages, whether it be lending, whether it be borrowing, whether it be credit cards. And I've run out of different things that the 10-year kind of assists in how things are priced. But if you look at it, the 10-year over the last 12 months, we had a low of 0.39% on March 9th. That was peak pandemic. Everything shutting down, the market cratering, money's piling into treasuries, driving prices up and yields down. If you remember on bonds and yields, they are inversely related. As yields go up, prices go down. As prices are driven up, yields go down. We had a significant amount of money pouring into treasuries, which drove yields down to a low unlike we have not seen. It was like an all-time low, 0.39%. The high for the year, and this is interesting, was on January 2nd of 2020, last year, at 1.9% on the 10-year. If you go back for the last 10 years, dang near to the day, the 10-year Treasury 10 years ago was at 3.74%, which that coincides with the last time we earned anything in money market. Okay, we did see kind of a rise back into that low 3% range back in 2017, only just to see things crater. Okay, currently the 10-year today closed at 1.09%. Now here's why interest rates are so important. I'm going to call this the Goldilocks analogy. If you remember the three bears, when they came in and they were tested, or Goldilocks was testing the porridge. One was too cold, one was too hot, one was just right. Well, here's the deal. Back in March, interest rates cratering to the downside, fear ruling the day. Obviously, that is when the porridge was too cold. Rates were very cold. Right now, rates are just right. Okay, but with that said, from a probability standpoint, and as you know, I'm big on math, I'm big on the data. Right now, data supports rates continuing to rise. Would not shock me to see the 10-year at 1.25%, that being 1.25%. It wouldn't shock me to see the 30-year north of 2%, in which the 30-year today closed at 1.85%. So I do think we are in to see some rates rising. Now, with that said, what would make the porridge too hot? It's if rates went up in a significant fashion much farther than what is being anticipated. Because what happens is right now, and why I say the porridge is just right, with rates rising, right now it's rising at a rate relative to the markets where they think this is a healthy increase in rates that signals a reflation of the economy. All right. Now, there's two times when we've seen interest rate spikes that have really adversely impacted the markets, because that's when they start to think that things are overheating, of which then that's usually when you get some type of market correction or pullback. The last time we saw that was in 2013, which you all probably remember the taper tantrum. You got to love these analogies or these slogans that these news people come up with. But back in 2013, we had the taper tantrum. What was the taper tantrum? All it was the Fed basically saying that they are going to cut back on their quantitative easing. It wasn't like they were stopping it. They were starting to cut back. Interest rate market freaked out. Markets cratered at the end of 2013. We did see them recover, and obviously things have looked really good since. Now, going back to March, pandemic, everything shuts down. Again, another spike in rates, markets are tanking. So when I talk about watching interest rates, watch not only where they raise to, but how quickly. If we start to see interest rates really escalating and you start to see the momentum in the rise in rates really start to take a very strong and steep ascent, that means that things are accelerating to the upside at a very rapid pace, and it wouldn't shock me to see the markets react accordingly to the downside, or volatility just rise and we see some choppiness. So keep an eye out on that, okay? Moving on here, Biden's stimulus package. He threw out a deal, 1.9 trillion with a T. You know, I've been teeing things up here lately, calling technical fouls because we've just been printing money. What's that? That smell is the printing press of our government smoking, okay? That's going to continue. Here's my guess. That deal is going to look a lot different than what he is saying. This is just, I'm floating the trial balloons. Float. Why? Because he sees what gets shot out of the air, and then everything has to go through Congress, House, Senate. It's got to go through the vote, right? So there's a lot that has to happen. It's going to look meaningfully different than it does here. This is called my wish list before Christmas when you're 10 years old. And for those of you that remember going through the Sears catalog with the pen, highlighting all the things you wanted your parents to buy you. If you don't remember catalogs, that means you're too young. If you remember catalogs, those were awesome. I used to get fired up for when the JCPenney's and the Sears and Roebuck's catalogs would come out, because I would go to town, I would get all fired up. But anyway, it's going to look a lot different, okay? It's going to look a lot different. See, I could do the Johnny Carson flip the card thing, but it's kind of a pad, and I would be afraid of what I would hit. So I'm not going to throw stuff. Although some of you who know me, I am accustomed to throwing things, not just cards, bats, helmets, kind of, You got to love that. And let's get on to COVID-19. I got some really good data here. Like I said, I was on a call. Neil Howe, who I had referenced last week, is writing a book called The Fourth Turning. He's a very esteemed demographer. He's a stud. I love him. He's a really good dude. He's got great information. And he was talking about how the second wave in the United States, actually around the globe, is still crashing. It's still coming in, okay? These are some 7-day trends I'm going to give you in the United States. We have a 7-day trend of 750,000 new cases per day. We have hospitalizations at 135,000 hospitalizations countrywide on a daily basis. These aren't new cases; these are just total cases. Okay, so don't freak out on me. We've got deaths, this is the sad one. 3,400 deaths per day is the 7-day moving average. Now, here is the positive: all these are decelerating. That is a positive. That is also something to think about on the economy. Think about that. Okay. What I also find interesting is initially you kind of had a lot of Americans refusing to get the vaccination. That is improving. We're seeing data, we're seeing feedback, we're seeing how people are viewing this as a lot more positive. And honestly, that is a part of really snuffing out this current shutdown that we have been experiencing for a little over 10 months, okay? If you look at number of deaths per million, right now the U.S. has grown or gained in stature. They are 4th place globally. Yeah, it's not a really good number that you want to see, and most likely, because all of these countries are in the northern hemisphere, except Peru. I'm not a big geography guy, but something tells me Peru is not. I think that's southern hemisphere. If I'm wrong, I guess I'm wrong. You know what? I was not a geographer. I took geography when I was in college. I don't remember it. That was my freshman year. I wasn't there to go to school when I was a freshman. I digress. Anyway, number 1 is Italy. They have 1,329 deaths per million. The UK is in 2nd place at 1,251 deaths per million. Peru is in 3rd, 1,165. And the US, a close 4th in 1,162. There is a transmissible mutation that's taking place. We're hearing about one from the UK. There's actually one, I think, in South Africa that I think has really got people troubled. It doesn't increase deaths, it increases how it's passed and how quickly it's passed. Here's the deal. Mutations equal adaptability, which is what the flu does, is what the cold does every year. This thing's probably most likely, I don't know if you can say those 2 words, probably most likely, in the same sentence, although I just did, albeit it is Friday afternoon. But it is something that, here's the deal, people. This is not the time to relax. We've come a long ways. I know people are getting tired of doing this stuff. I know they're tired of wearing the masks. I know they're tired of social distancing. They're tired of all this stuff, and I respect that. This is like running the mile and you are on the last lap, okay? This is a time where you kick it in and you finish strong. We all need to finish strong. We all need to care about others because, again, it's not about ourselves. When we embrace doing these things that they're asking us to do, which is masks, social distancing, trying to limit contact with people, stay in your little groups of family or the people that you know, because we're not doing it for ourselves. You're doing it for others. And I want to remind you of that. This is not a time to be selfish. This is not a time to be angry and have an attitude, which so many stinking people do. And you know what? This is a time to breathe and go, you know what? This is the 4th lap of the mile. And you know what? I have to bear down and I have to toughen up and I have to finish. Okay. So in closing today, this is a short one, 14 minutes. Wow. I don't know. I'm probably excited. My son's flying home this weekend, 3-day weekend. We're not working Monday. We're going skiing tomorrow and Sunday. So if any of you are up on Mary Jane, you probably won't see me because we're going to be ripping and I'm fired up. So anyway, this is Craig Modelmog for Wall Street X's and O's, and this is Friday, January 15th. It is always great to see you guys. Keep an eye on interest rates, okay? Interest rates and the unemployment piece are going to transition to the market side, where if interest rates stay in a happy place, unemployment starts dropping, vaccine gets disseminated or gets continued to be passed out, and when numbers continue to drop, things reopen. You know what's going to happen? things are going to start rocking. Okay, from a probability standpoint, Q1 GDP could be a number unlike we have seen in 80 to 90 years. I'm just saying, could be a big one. All right, those numbers are going to do wonders on the market. Right now, we are positioned very bullishly. We owned large cap on the growth. We own small cap on the growth. We own emerging markets. Those are things you want to own in addition to commodities. Why? Dollar down, inflation up, commodities are expanding in value or cost because it's not getting any cheaper to go grocery shopping. So keep your eye on the ball. That's what I tell you guys. Focus on the data, take your heart and emotions and check it on the side, and that in itself will help you be a better, more consistent investor and make good quality decisions based on data, not emotions. So once again, thanks for joining me. Craig Modelmog, Wall Street X's and O's, Friday, January 15th, and I am out.